nine, eight, seven, six, five, four, three, two, one.
Hello and welcome to the Newchip Accelerator Q4 Online Demo Day Global Startup Conference. My name is Armando Vera Carvajal, and I'm the Accelerator Director here at Newchip. Now, we're very excited to have hundreds of investors and entrepreneurs here joining us from every corner of the world. This is our biggest demo day to date. We have well over 100 global startups from the Newchip Accelerator pitching over the next 4 to 5 days. And we also have over 20 industry panels and guest speakers participating in a diversity of discussions focused on addressing key issues that are very important today in the startup world. Now, to kick it off today, it's a sincere honor and pleasure to introduce a very, very special guest. So please, let's give a warm welcome to Tim Jackson. Tim, it's such a pleasure to have you here, and I'm so happy that you're able to join us for this important talk. Before we dive in,
it's great to see you.
Absolutely, it's great to have you.
Great to be here. Thank you.
Yeah, no, absolutely. And before we dive in, I'd love to share some details on your background to share some context with our global audience. Tim Jackson is a CEO coach, investor, entrepreneur, and tech commentator. He's a general partner at Walking Ventures and has been an active early stage investor since 2000 and an advisor and non-executive director to a number of private companies, and coaches a number of founders and CEOs who've raised rounds between $1 million and $20 million. Now, Tim also served as managing director of a $700 million European technology venture fund formed by the Carlyle Group, a US private equity firm and one of the most powerful in the world. Formerly, Tim was founder and chief executive of QXL, a publicly traded company that was sold in 2007 for $1.9 billion. Now, Tim also wrote a weekly technology column for the Financial Times for 7 years. He was previously on the staff of The Economist, which I love to read every week. And Tim also served as a foreign correspondent and bureau chief in Tokyo and Brussels. Lastly, Tim studied philosophy, politics, and economics at Oxford, and he's the author of 3 business books, one of which is on Richard Branson, which I'm a very big fan of. Tim lives in London, and he has 4 children with his partner and artist. Tim, we really cannot thank you enough for the time and support that you're providing, not just our companies and investors, but also the global startup ecosystem. So thank you once again for being here. Now, to kick this off, you've played a lot of different roles in the startup ecosystem. Can you tell me a little bit more about those?
Yeah, well, I guess what I'd say is that quite a lot of stuff changes over time and quite a lot also stays the same. So for example, when I was starting out as an entrepreneur, AWS, as we know it, didn't exist. And that meant that if you wanted to have a server, you had to buy a machine and you had to either co-locate it somewhere where there was already a T1 internet connection, or you had to get a big internet connection. And likewise, if you wanted to hire some people and open an office, you had to decide whether you wanted a 1-year or a 3-year lease. Things have got a lot easier in many ways for doing startups. And I think the result is that you can probably get the same distance with $1 million today as it would have taken $10 million to get to a decade ago. And likewise, 100,000 will get you to the place where $1 million would have been required 10 years ago. So quite a lot has changed, but I think quite a lot of things have stayed the same too. And perhaps the most important is that outsiders look at startup CEOs and they see them as kind of privileged people, people kind of living in a bit of a bubble, people who are trying to change the world. There's lots of bad stuff happening around big tech companies right now. And I think that the thing that hasn't changed is that it's really hard to run a company.
Obviously, as you said, the evolution for entrepreneurs has been enhanced, right? You require less capital to do much more nowadays, but still the fundamentals still do apply. Now, you've been around, Tim, for 2 previous booms. And boom and bust cycles, what's changed in the ecosystem? And specifically, I want to frame this in the context of the ongoing crisis we have right now with COVID-19 and how that's impacting the current cycle we're in.
Well, I think one thing that's very striking is that the behavior of investors in particular is much more dependent on sentiment than you might think. And if you're an entrepreneur, you might look at somebody running a fund and say, whoa, they're sitting on $250 million or $500 million of money, and their job is to invest it, so they should keep going, right? And yes, that's true up to a point, that venture capitalists do have a mandate to spend the money. The returns they make are surprisingly closely related to the vintage year, the year when they started. And the people that start when the cycle is at the bottom and sell when the cycle is at the top tend to do a lot better than those who start when the cycle's at the top. But it's also important to be aware that VCs are kind of people too, and they have vulnerabilities and fears as well. And one of the things that's striking is that when the market is just going up, 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 and everybody's incredibly optimistic, then you get deals done that are on very company favorable terms. You get uncapped convertibles in which somebody's paying now for the right to invest at a discount off a price that will be set in a year or two's time. And one of the things that happens when markets turn, and I'm not just talking about the hiccup, the 30% retraction that happened earlier this year, I'm talking about a decisive change from a bull market to a bear market. When markets turn, then very often the balance of power between investors and entrepreneurs changes. And the result is that it's often the top quartile or the top half of companies that get invested, and the bottom half will not succeed in getting funding anyway. But also the terms become a little more investor friendly, and the expectations in terms of entrepreneur behavior become a little bit more rigorous. And these things will be new to many people who are under the age of 30. But if you've seen it go round a couple of times before, then you'll know that this is going to happen. And what that means is that even when VCs are saying, yep, we're all continuing on just like we were, we're as excited about tech as we ever were. Yes, that's true. That absolutely makes sense. And I'm a big believer that tech will continue to change the world. Despite that, I think you should expect to see some significant differences in terms.
Yeah, no, and I absolutely agree. And, just given what you just mentioned, what are your current thoughts on where we are today? Do you think we're in a bubble? Are there micro bubbles across different industries or sectors? Or are we just getting a bigger pie, so to speak, for investment deals and valuations?
Well, I think it's fairly clear that there's a disconnect between the stock market and the real economy in the US and Europe and Asia. And that it's almost a weird paradox to have large numbers of people unemployed on the one hand, and public equity investors making money hand over fist on the other. I would say that there are the kind of obvious strategic shifts taking place, from offline to online in a number of spaces. Transport is changing, land use is changing. And perhaps the most important thing that's changing, I would say right now, is that lots of industries have found that they were kind of banging on the door, trying to persuade, especially corporate clients, to change their ways of doing things, and trying to say to them, look, we think there's a way in which you could do this better and cheaper. And those clients weren't listening. And one of the effects of COVID has been that people were forced to try stuff out. Here's a tiny example. One of the people I know who runs quite a lot of the primary care services in London said that he had spent 5 years trying to persuade his colleagues of the value of telemedicine, of delivering medical services at a distance by video call. And they had 101 great reasons why it wasn't going to happen. And then suddenly the pandemic came. And guess what? Their own fear about exposing themselves unnecessarily to infection prompted people to reevaluate. There's a bigger issue here, which is that often the obstacles to adoption of something new are as much psychological as practical. And that when you get a systemic change, when a step change happens, that makes things possible that weren't possible before. So the paradox is, even though I'm pessimistic over a kind of 2-year view in terms of markets, bull markets and bear markets, I'm more optimistic than I was before on a 5 and 10-year view.
We've seen that a lot, especially here in the Newchip Accelerator with hundreds of startups around the world, many of which were struggling to really prove, if you will, that value proposition to investors and customers before COVID. And then, as you said, COVID just hit, and all of a sudden, the world is scrambling online. The world is scrambling for alternatives to stay afloat. And many of these solutions that used to be afterthoughts or back burner considerations are now top of mind. So it's very fascinating to see how many startups or even corporates were very hesitant to do, say, for example, the working from home. And now that became a thing of life. We are reevaluating, what does it mean to be in the office? What does it mean to work from home? What does that mean for business travel? I'm excited about what's going to come out of these changes for the world at large. And I think, as you mentioned, they're psychological and the practical factors, but I think in the end, if it's really solving a real problem that's not just going to happen today, but into the future, it will probably stick around. Shifting this a little bit, I wanted to talk a little bit about coaching, because you're a prominent CEO coach. And an interesting fact here is that you're known for taking startup founders on walks in Hyde Park in London as part of the pitch process for your fund. Interestingly so, you never ask anything about business and revaluation. Instead, you focus just on getting to know the entrepreneur as a person. Now, to this point, like I said, you're a highly regarded CEO coach. So what prompted you to start coaching CEOs?
Well, it's interesting, actually, that you mentioned walking in the park, because the reason that I started doing that was partly just because I liked it, but also because I think that if you look at the process that most VCs go through in terms of decision making, the decision is mostly about three things. It's about the people, the product, and the plan. And yet, if you visualize the typical meeting that a company pitching at a demo day will have when they're following up with a possible investor, they'll be showing the product and they'll be talking about the plan. And they'll have a slide deck, and they'll typically be in a conference room. And somewhere on slide 17 or whatever, there'll be a slide headed team, and it will have 10 words about each of the people and little photos of them. And it struck me that since what I've learned as an investor from kind of 50 investments in different portfolio companies is that actually the people are much more important than either the product today or what the plan is in the future in determining the outcome. And that's not surprising if you think about it, because a product can typically be changed in 3 months, and a plan can be changed in a weekend, but the people are not so easily changed. It struck me that it made much more sense as an investor to, as it were, front end the due diligence process by trying to learn more about the people. And in a way, I think that chimed with some conversations that I'd been having with later stage CEOs who had backed companies that we had seeded first, about the kind of success factors in many businesses. And that actually it's very often the case that one of the biggest obstacles to success of a given company is the issue of whether the CEO can scale, can grow as fast as the company can. And I had very much experience of this myself, because even though you read out my bio in a very flattering way a few minutes ago, I wasn't a very good CEO. And I realized I wasn't a very good CEO quite early on. And I tried actually to recruit my own successor. And I actually offered the job to 3 different people in succession, all of whom said no. Finally, the one that said yes was the one who got offered the job and who joined just before we IPO'd the company. So he did the roadshow and I wrote the registration statement for the SEC with the lawyers. But the key thing here is that actually CEOs get less support than you might expect. And even the most value-adding venture capitalists have typically got multiple board seats. 6 to 10 is not at all uncommon. They're supposed to spend a third of their time scouting new deals. They're supposed to spend a third of their time figuring out how to exit, how to make money for their investors from their existing investments. And they don't have nearly as much time as you might think left over for helping their existing portfolio CEOs to grow with the job. And after having looked through our portfolio, I came to the conclusion that there's a number of skills going across macro to medium to micro in terms of whether it's kind of big picture stuff or small detail. And whether it's stuff about you or about your team or about the people who report to you or about the company as a whole, which actually, if you're building the airplane in mid-flight, as the analogy goes, it's quite hard to do. One of the things I'd learned was that for CEOs, having someone that they can have a confidential and detailed conversation with about the challenges they're facing is much rarer than you might think. And that's partly because there's a lot of people who, as it were, define themselves as coaches, but their key qualification in the area is a PhD in psychology, which is fantastic. That's great for kind of helping you feel good and helping restore your self-esteem and so on. But actually, startups are different from many other kinds of companies, and being a CEO is a different role from many other job titles. And I think it's hugely valuable if you're running a startup as a CEO to be talking to somebody who really knows what it's like to be there and who isn't going to have unrealistic expectations about what you ought to be able to achieve.
Yeah, no, and it's so true. And we see that firsthand here at Newchip, the Accelerator. We see that need tremendously, right? Where you have startups and then you have the leadership, the CEO, sometimes the other co-founder, and who do they go to for help, right? Especially if they don't have investors yet. And I think that's, as you put it, very, very important need, having that trusted source where you can go to for guidance, go to for advice, but the real advice, not just practical investment or strategy advice, but how to be an effective CEO, how to make those tough decisions. So I really value that you take that seriously as a CEO coach, and that it's an integral component of what you do for your deals.
Can I just add something on that point, by the way? It's very striking that, you know, the best VCs will always say, call me anytime. Anytime you've got a problem, just let me know. Remember, we've signed the investment agreement. We've given you the money. We can't take the money back except unless a very short list of really terrible things happens. In all other circumstances, we are in the same boat as you. So you can be fully open with us. That's all true. And it's said in good faith. But it's also important to realize that the best CEOs know that every conversation they have with an investor is an investor relations conversation. And so if you call up your biggest investor in tears at 10 o'clock on a Friday night and say, I don't think I can carry on with this, maybe I wasn't cut out to do this job, then what you can hope for is that they'll be sympathetic and they'll be a good listening ear and they'll give you some good input. But they cannot forget what you've said, and you cannot unsay those words. And consequently, when you come back again 4 weeks later and say, yay, we're going to build this into a $10 billion company, they will at the back of their minds know that relatively recently you weren't so sure. And I think that's why often the best CEOs realize that it's good to take input and advice and views from investors, but it's not necessarily the right thing to open up to them your greatest fears, your greatest worries, your greatest weaknesses, the dumbest things you've ever done. Exactly. And as you put it, there is a sort of need for CEO therapy, but not all entirely psychology, right? They're there to help you address a lot of the more structural and practical business problems that you're facing as an investor, but not necessarily all the other nuances that we all have in life. On that similar vein, I wanted to talk a little bit about CEO replacement. Why? Well, because change is constant in startups. You know, many people come, and oftentimes many more will go. This is the flux, right? This is the flux that entrepreneurs must stomach as they risk it all to build real businesses with real potential for long-term sustainable success. Interestingly, one thing that's not really talked often about is how often startup CEOs get replaced. And you mentioned a minute ago, sort of like when you were trying to find a replacement for the company right before it IPO'd and did the roadshow leading to a public float. So why do you think so many startup CEOs get replaced, and why don't we hear more about this? Well, that's a really good question. And I think the most important thing I learned about this was when I was a Kaufman Fellow. I don't know if you know about the Kaufman Foundation, which is an organization that trains VCs from around the world.
Yep. And
I spent a couple of years as a Kaufman Fellow. And in one of the private meetings that we had, where there were 45 VCs from Silicon Valley and around the world, and there were, you know, an ever-changing cast of prominent investors talking about their experiences and what they'd done. One of the VCs put it very bluntly. She said, we expect to replace 3 out of 4 of every one of the CEOs that we invest in.
Wow.
Now, it's a bit like that old joke about advertising where the guy says, you know, half the money we spend is wasted, but we don't know which half. The same thing is true of VCs. They wouldn't invest in your company mostly if they thought they needed to replace you tomorrow, but they do know that statistically speaking, they're going to have to replace quite a lot. So why is this? Well, I think it's because of 2 things. One is that the skills that you need to run a company are very different depending on the stage that you're at. And you know, an obvious way to see that is to think about, what do you need to quit your day job and decide to start a new business? Well, you know, you need to be pretty daring, and you need to be a bit of a rebel, and you need to be willing to take risks, and you need to disagree with the rest of the world and your parents and all your friends who say it's a crazy idea to jack in your job and go and do something like this. By the time you have got to the stage of raising a little money and hiring half a dozen people, now you need something very different. You need to be able to infuse and persuade 5 people that they should quit their jobs and come and join you. And you need to convince them that your vision isn't a completely stupid one. Another year on, you've got 25 employees. And now what are you looking for? Well, the people who report to you are no longer individual contributors. They're no longer just people doing a job where you can look at the job individually and ask how it's going. They're likely to be people who are running a team of people. And now your job is to help them manage that team of people. So in short, that's one key thing that explains why CEOs get replaced. It's that the definition of success is different depending on the size and scale of the business. And it can change so fast that somebody who's been doing incredibly well 1 quarter ago can look out of their depth 1 quarter from today. Mm-hmm. But there's another reason as well. The other reason, I think, is to do with communication and time. When you're a CEO or a founder, it's quite tempting when you're reporting to your investors and your board to maintain their enthusiasm, to make them feel that they did the right thing by giving you a bunch of money, and to convince them that you're going to do your damnedest to make a success of it and make their investors rich, if they weren't already. And the effect of that is it's very common for CEOs to show up to board meeting after board meeting, talking about all the great new things that have happened, skating perhaps over the things that have not gone so well. And therefore it happens that when there's a serious setback, without anybody having been deliberately dishonest, it can often be the case that the investors are truly caught by surprise. And that's something that I've found quite a lot, actually, with CEOs that I work with in a coaching capacity, that it's very helpful for them to know what the likely results on their relationships with their investors will be if they choose option A, option B, or option C. And that very often, simply the right kind of transparency and the right kind of clarity and the right kind of inclusiveness in making decisions at a board level can be hugely valuable in preserving the board's confidence in a CEO.
So it sounds like there's a lot of push and pull there. Do you think that, looking at your situation when you were looking for a replacement, that was something that came out of your own volition? You knew that you wanted to have somebody else leading there. Do you think a lot of these replacements are happening as sort of like an imposition by the fund? Or do you think a good percentage of those founders also say, like, I recognize I'm not going to be the CEO that my company needs to grow, so I need a replacement? What's the sort of like percentage split that you see?
I would say the split is 80-20 in favor of pressure from investors or boards, right. And that those therefore represent the vast proportion of CEOs who move on. Mm-hmm. It's funny, when I was a CEO, thought about it from a very different perspective. The way I thought was, I'm not really wrapped up in the idea that I want my gravestone to say I was a successful CEO. And therefore, I saw it very much as a matter of coincidence that I happened to be running a company, and I saw myself more as a caretaker than as someone whose identity was deeply wrapped up in this job title on his business card. And I think that when I'm talking to CEOs and coaching them, one of the things I often say is that it's worth remembering that you have 2 roles in your company. One is that you do a job, you're an employee. The other is that you are a shareholder. You're often the biggest shareholder in the company. And what happens if those two interests conflict? What happens if actually it would be in your interests as a shareholder to have somebody take over and run the company more effectively than you can? My own view is it's pretty straightforward. If you get to that conclusion, it's probably wise to move on.
Oftentimes, the way that I see it in the field with startups and CEOs is they identify themselves as either the visionary or the operator, and we get them to be very vocal about that. It's like, are you a visionary or are you an operator? Obviously, all CEOs for startups need to have a vision. They need to be visionaries. But in practical terms, do you, X, Y, or Z, see yourself as the person who's going to be taking this company to long-term success as the operator, or more as the person at the top who's driving forward that strategy and brand and inspiring the team, which is already very challenging? Now, what are some of the...
Can I just comment on that?
Yeah,
I think it's incredibly valuable that you're having that discussion with your portfolio CEOs. And what I would say is that quite a lot of it is to do with whether you have a static or a dynamic mindset. Mm-hmm. And that if you have a growth mindset, then you don't necessarily look at the skills you have now and say, that's the person I am and that's the only thing I can ever do. It's important to be aware that actually there may be skills you don't have now that you could learn, but you have to have a commitment to learning them. You can't go in saying, I know how to do this and I know how to run this business all the way to $10 billion in sales.
Yeah, no, and that takes me to the follow-up question that I had for this, because it made me wonder, well, what are some of those key skills that you would need to succeed as a CEO, especially in today's hyper fast evolving world?
Well, I think that hiring the right people and knowing when to admit to your mistakes is a pretty crucial one. I actually have a matrix of 9 skills that's a 3x3 going across. But if I pick the ones which I think are often in scarcest supply, it's surprising how few CEOs do not have a hiring mistake that they've made that they haven't yet corrected. And the paradox about that is that very often of course, if you get rid of somebody that you've hired, you're not just doing something for yourself, you're changing their life in quite a profound way. And most startup founders are kind people and don't want to be unkind to somebody that they've hired. I think another issue is probably probably the specifics of how you manage the people who report to you. And I do a lot of work with startup founders and CEOs on the subject of one-on-ones. What happens when you've got half a dozen people, they all answer to you and you are responsible for them succeeding, and you get a chance to see each of them individually? What should you say? What should you ask them to bring? What should the deliverables and the decisions of those meetings be? It can make a huge difference to the outcome of your company if you know and have the right skills for running one-on-one meetings with your key staff.
Yeah, no, and that goes back to sort of what you mentioned a little earlier, communication and understanding those dynamics with the team, which are fundamental to building out the company.
Can I add one other thing? I don't want to go through the whole list of 9, but perhaps one where it's hardest to do by yourself and is most valuable to have some individual input is about focus. That pretty much all the CEOs I know work very hard. The problem is not that they are leaving work early and goofing off and simply not putting in the effort. Those people tend to get weeded out pretty early on. The issue is that they may be devoting huge amounts of effort to things that aren't the right things. And it's a little bit like, the comparison between the two people, one of whom climbs Mount Everest and the other one simply takes a cab to the center of town and steps into a building and presses the elevator button to get to the top floor. If you can find shortcuts, if you can find things that will get you to your destination faster with less work, allowing you to concentrate on what's really important, that can make a huge difference.
Yeah, no, I see that quite often as well, where the passion's always there. And I fully agree that CEOs who see entrepreneurship as a hobby or something that they can do on the side or not put in as much effort, eventually, sooner rather than later, do get weeded out just because of the circumstances that surround that roller coaster that is entrepreneurship. So very, very interesting. What are your thoughts on how to refocus someone? Because I see this quite often where there's a lot of passion, there's a lot of focus on several key initiatives in any given startup. And it's almost like the founders are oftentimes just very set in their ways. How can an investor help refocus that entrepreneur to make the biggest impact?
Well, it's pretty hard for the investors to do it because, of course, by the time the founders get to a board meeting and they've prepared a board pack, the reality of the chaos inside the business can be repackaged as something that looks much more thoughtful and much more organized than it really is. But if you're not in a context where you're around a boardroom table and the CEO is under pressure to look like everything's just fine, I think that attaining focus is something that actually takes a number of steps. So one of them is simply a brain dump of everything that's on your mind and all the tasks that you're trying to accomplish. And that's something that was pioneered 20 years ago by Dave Allen in his book, Getting Things Done. Just make sure that you don't have the stress of thinking, oh heavens, there's a whole load of stuff I need to do, but I can't remember what it is. And so simply having that list is hugely valuable. Then perhaps it's also important to identify what are the things that really have to be done by you. And if you think, for example, about Tim Ferriss's advice in his book, The 4-Hour Work Week, where he talks about, delegate, automate, eliminate, there's a lot of things that people end up doing themselves that actually they need not necessarily do. Right. And it's quite important to take those out of the mix as your next step. And then perhaps the third step is to look at the individual big projects that you're thinking about and try and identify which of those is going to have the biggest result, the biggest effect on the outcome, and trying to think through how you can juggle your time allocation between those things. If there's one thing that will account for 80% of the outcome of the entire project you're working on, and yet you're spending only 5% of your time on it, that can be quite hard and not easy to succeed at. Now, the paradox is that the way I describe it makes it sound incredibly obvious, and yet what I found is that even the smartest CEOs find it very, very hard to do this in dialogue by themselves. And it's much easier if you've got somebody to whom you can lay out everything and then say, so where am I? And you're not looking for somebody to tell you the answers. You're looking for somebody to ask you good prompting questions that will help you get there by yourself. And, good luck trying to do that with a board member, because if you, as it were, reveal your full long list of ideas and projects and things you're thinking about, then your board member is likely to come away with a feeling that you suffer from a fatal and irreparable lack of focus.
Right. And then by then it's almost too late, I would imagine. You mentioned a bit earlier that you think that the job of the CEO isn't just one job. It's much more than that. Can you explain a little bit more on that and how that relates to the stages of a startup as it grows?
Well, I think probably the single biggest stage change is when you move from managing, as I said earlier, individual contributors to managing managers. Right. And one framework which I came up with and which I often use to work with CEOs on is something that I call SCRIM. It's an acronym that stands for the 5 things that you are responsible for the people who report to you. You're responsible first for making sure they're suitable. Ultimately, if you made a hiring mistake and the person is the wrong person for the job, then if that is abundantly clear, then it's not a good use of resource to keep trying to support them and help them and fix them. Second is that while you want people who have got the right qualifications and the right attitude and the right skills, you're not going to be able, unless you've got a virtually unlimited budget, to find people who've always done before everything that you need them to do in their current job. And so it is your job as CEO to coach the people who work for you. But coaching them isn't enough. You've also got to make sure that they can execute and deliver reliably on what they know how to do. So, for example, somebody who's a head of sales and who has a team of salespeople reporting to them they need to speak regularly to those people and make sure that they're motivated and that they're working hard and so on. And it doesn't matter how well you know in theory that that's what you need to do. It's hard to be a successful VP sales unless you're doing that. So making sure that the people who report to you are reliable is also important. But incentives matter too. And that doesn't just mean bonuses and stock options. It means making people feel valued and making people that they're learning something and benefiting from being in the company. And when you're a CEO, you need to pay close attention to how engaged, how involved are the people who are reporting to you. And while it's tempting simply to complain about somebody who appears not to be motivated, it's important to remember that motivating them is your top responsibility. And then finally come metrics, that actually it's very valuable to be able to measure what you and your team are doing and to know what to be looking at in order to identify problems and fix them. And that probably means, if you're a CEO, that for every one of the people who they need to know and you need to have agreed with them, what are the metrics that you are looking at that are making sure that their efforts and their team's efforts are taking the company in the agreed direction.
That makes perfect sense. And tying that to what you mentioned earlier, CEOs who lack that skill set, right, to fulfill all those jobs tend to get replaced by the investors, because it is a lot of different jobs necessary for taking that company to that next stage. You mentioned something interesting about sort of like the CEO's job is to also coach internally, leadership, individual contributors, etc. How do VCs normally react when their CEOs say, I want you to coach me, right? You talked about this a little bit earlier, sort of like the dynamic between them, but what is a typical expectation and reaction there?
Well, it's interesting that what I find actually is that with the most successful VC firms, often the suggestion or the initiative comes from the VCs. That the VCs will say, look, we have just given you $8 million. So you know that we think very highly of you, and you know that we think you can do great stuff. And therefore, when we suggest that you should go and work with this guy so that you've got somebody that you can talk to between board meetings who will help you try out ideas and help you think through issues, you know that we're not criticizing by suggesting that. And I think that ties back exactly into what you were saying earlier when you were talking about CEOs that don't have the skills. Because what I know as an investor is that going through a CEO transition where one leader in the business is replaced by another is a very slow, very painful, and very expensive exercise. And that's partly because it will typically take 3 months before the CEO realizes that there's a problem, another 3 months before the investors realize that there's a problem, a third 3 months before they decide to do something about it, and then a fourth 3 months before they've done anything about it. And the result is therefore a year of drift. Right. And therefore what I found is that despite what I said about that VC who said that she expects to replace 75% of all the CEOs that she invests in, actually most VCs are extremely happy if they see that a founder who doesn't have all the skills that they need right now is moving in the right direction. Mm-hmm. Very often that's what you need to show. Not that you know everything, not every skill required to run the business a year from now, but that the line is going in the same direction as the growth curve of the company. And if it's doing that, then typically you will win and retain the confidence of your investors.
That's excellent. And to that point, I want to take that sort of in the opposite direction. What happens when, founders have bad relationship with their investors? And I would even venture to say, like, how often do founders have bad relationships with their board and their investors?
I think it's perhaps a little more common than people let on because nobody wants to wash dirty linen in public. And it's probably the responsibility of both sides. On the one hand, the investors are super smart, contrarian people. And it's surprisingly often the case that a VC will come to a board meeting having been given a board pack and will kind of psychologically think that it's their mission to find the hidden truth behind this presentation. And they can be a little bit aggressive, a little bit negative, a little bit too interrogatory in the way that they quiz the CEO about what's going on. But there's also a degree of founder-CEO responsibility as well. And that is that when things are going partly well, it's easy to succumb to the temptation to try and not explain in full what's not working. And the interesting thing is, it's a bit like whichever US president it was who said, you can fool all the people some of the time and you can fool some of the people all the time, but you can't fool all the people all the time. That if you present a relentlessly upbeat picture of your company, but the metrics over time don't bear out the picture that you're presenting, that will cause a loss of confidence by the investors. And I think that that often can result in bad relationships.
Exactly. And, tying that to taking that a next step, what do you think is the most common mistake that startup founders make that often lead to those frayed relationships?
Well, if you look across the whole range of stages, I think obviously there's a huge range, and there's no single mistake that's, that accounts for 60% of all startup failures or something like that. But probably the single most common one of many is not being realistic enough about cash. And I mean that in three respects. The first is that we are all natural optimists, and we all hope that people will love our baby. And therefore, the product that we have created, we hope that it will fly off the shelves and that everybody will want to buy it as fast as possible. And that means that it is fairly common that sales projections are more optimistic than the reality that actually follows. And that self-evidently has an effect, because your forecast, if you're a startup, is all about the interplay between costs and revenues. And if the revenues fall short and the costs stay the same, then inevitably you are going to run out of money faster than you would think. And that implies, therefore, something important, which is that runways are often shorter than startup founders and CEOs expect, and therefore they don't plan early enough for a less optimistic outcome than they hope for. And I've seen some difficult conversations between VCs and entrepreneurs where the VCs have said, look, I think you're going to run out of money at this rate. We need to do something now. And what I've seen is that actually, when I'm working with CEOs in a coaching capacity, it's often much easier than you would think to look at costs a little bit sooner and to make some adjustments without having to wait for something that is really lurching and painful very late in the day.
Yeah, no, cash flow management is, without a single doubt, one of the most important and oftentimes most forgotten component of driving a business to success. And here at Newchip, we generally advise startups to have at least 18 months of runway. And because our companies are actively raising, that tends to be the goal. Some of them say, well, I just need 6 months or 10 months or 12 months. But 18 months is what we generally say, like, plan for more, because it doesn't hurt to have that extra cash. And I can say that with confidence. Around this time last year, companies that didn't want to have that much runway suffered a lot when coronavirus hit, because now, they're struggling to survive, and having that bigger outlook could have made a bigger difference for them.
I think that's rare and extremely valuable that you're doing that with founders. It reminds me, I was walking a couple of years ago in the park with an entrepreneur, and he was talking about his product and what the price point was and what the sales cycle was and how much cash the business had and how many employees it had and so on. And after the discussion, I said to him, look, I'm really sorry, but I have to be honest here. I'm not your coach and I'm not your current investor, but I've got to tell you that I don't think the trajectory is heading in the direction you want. And I'm very concerned that what you might need to do is to cut your headcount by 60%, because you've got a great product here. But unfortunately, it's the old line, the grass is growing, but the cow is dying. You're not going to be able to get this product to market in time to really test whether it's any good or not. And the guy was very receptive and was clearly very thoughtful and was considering it. And I next saw him 3 months later. And at that point I said, so, what happened? And he said, well, I actually raised the issue that we discussed with the board, but we had some other stuff on the board agenda, so we didn't get to discuss it at the next board meeting. And the one after that, some people were on vacation. So we discussed it at the next board meeting after that. And we then did decide we really were going to do something. And I said, great. Okay, so what happened? And he said, well, sadly, we're now fire selling the assets because we did make the change, but we did it too late. And we've only got 3 months of cash left. So we're looking for people who want to buy the technology or buy the team and at least it won't be a complete bust. That kind of thing is a real shame. And even, it's a different category of issue from starting with an 18-month runway. It's about the hard decisions that you might need to make at 12 or at 9 or at 6, so that you don't have to make catastrophic decisions at 3 months.
Exactly. And I'm so glad that you recognize that as well as an entrepreneur and an investor. Bringing this sort of to a close, right now we're in demo day. We have hundreds of startups pitching to investors around the world, lots of different industries and verticals. You shared some amazing insights and advice and tips, really. But what do you feel is the most important thing that CEOs need to know when they've just done a successful demo day?
Well, I'm kind of reminded of that line of Winston Churchill's during the Second World War, when they won some small victory, and he said, "This isn't the end, this isn't the beginning of the end, but it's the end of the beginning." Right. And I think that demo day is the end of the beginning. Right. And you often, if you're the CEO, then you often come off it with a high, because it's very exciting to have shown your product, to have convinced investors, and to have got handshakes or term sheets or actual signed investment documentation from people who are going to give you money. And it's very tempting to smoke your own stuff and to believe that all the predictions you made in those beautifully put together slides must come true because they were in the slides. And likewise, your investors, VCs are by definition optimistic people. They have to be, because they know that 80% of their deals are going to fail, and it's the successful ones that they're going to make their money from. And so everybody around the table comes to this with a bias towards optimism, which is exactly as it should be. But here's the point. What typically happens over the next 3 to 6 months is that sales are quite uncertain, and that it's hard to know how quickly or at what price or at what total revenue number the forecast sales will come in. But the bit that's easy to execute on is the marketing programs, the hiring, the big investments, the building out of new versions of product. And what therefore tends to happen is, it's a fairly common pattern that in post-demo day companies, in the discussions in the 2 quarters after the deal has been done, there's lots of optimism between both the CEOs and the investors. And things all seem to be going well because lots of new people are being brought in and lots of programs are being put in place. Now, paradoxically, that is also the moment when it is most helpful to actually look at what's really going on with sales. How is the pipeline changing? How long is it that people are staying in stage? Are the conversion rates that you expected the same as what's actually happening in fact? And this is the moment where you suddenly get to have a great deal more information than you had 3 months or 6 months ago about the likely trajectory of the company. That information, 80% of the time, tends to the conclusion that it's going to need more money and it's going to take longer than you expected. And that's a difficult conclusion to reach if you're an entrepreneur who just made a load of implicit promises to a load of investors. You don't want to spoil your relationship with them. You don't want them to think that you were dishonest in any way. But those first 2 quarters are a hugely valuable time for honesty on both sides. Now, let's look very carefully at each new data point that comes in and see how we can use that to hone our plan to make it as realistic as it can possibly be. That's not a single discussion. That's not a single meeting. And I've often done that with CEOs before they've gone to their investors over a succession of sessions. But in some ways, it can be the most valuable thing to do, because it can then mean that you are orienting the company in the right direction so that you don't have a year down the line a big panic because that 18-month runway has turned out to be a 13-month runway.
Right.
But the big picture is that there's a lot of bumps on the way of being an entrepreneur. There's a lot of difficulties in building a business. But getting to a demo day, talking to investors, coming to agreements and getting to build stuff, it's fantastic. It's incredibly exciting. And we're all deeply privileged to be doing it.
Tim, that was excellent. Thank you so much for sharing your time with us today. It's been a real pleasure and unique opportunity to learn about your perspectives, your insights and experiences, both as a highly successful entrepreneur and also a professional investor, Carlyle Group, and also now with your own fund. As a parting thought for our audience, what actionable advice would you give to entrepreneurs who want to change the world for the better?
There's many things, but if I were to think of one that's perhaps not given the weight it should be, it's to think about the product or service that you're building and think about the person that you're building it for, and asking yourself in detail, what is their job to be done? What are they trying to achieve, and how is your product making it better for them? And I think that a lot of entrepreneurs focus on the way they present, the things they say, branding and so on, without really asking themselves tough questions about exactly that. And in the end, it's to a much greater degree than we like to admit about the product. If you build a product that's really valuable and really useful, then that is the most important thing to be focused on.
Absolutely agree. Absolutely agree. Thank you for that, Tim. Once again, thank you for your time. We hope that you'll join us again sometime in the future. And we thank everybody who tuned in to this very special talk with Tim Jackson. Tim, thank you so much.
Terrific. Thank you for having me. And I'm looking forward to seeing the companies in more detail. Bye-bye.